So in our first segment on CLOs, we discussed the structure, as I've shown here, and how it looks like any business in corporate America. And I really focused on the concept of the reinvestment style CLO, which is a CLO that typically has a life cycle that'll range from 6 to 9 years. Usually has a reinvestment period of 5 years, and then the wind down thereafter, which takes a period of time based on prepay and just how quickly the CLO winds down. The second one I want to focus on briefly is static CLOs. Palmer Square has been a pioneer in the static CLO space. We've been out in the market since Q4 2015. We've had a highly successful track record. We've now been involved in 9 static transactions and really view it as a programmatic issuance opportunity where we can be in the market quite often. Why is that? Well, in a static CLO, you take away the concept of reinvestment. It's gone. There is no reinvestment period. So what does that mean? That means that this portfolio at closing is fully ramped, and that is the portfolio that is going to be present going forward. It's not going to change. And well, what does that mean? Instead of having a 6 to 9 year life cycle, what does taking the reinvestment period out mean for the life cycle of a static CLO? What it means is that a static CLO really lasts about 1 year to 2 years on average. And the reason that is bank loans always have a built-in prepayment rate. It just really matters how much. Is it as low as 10% or is it as much as 50%? And we've seen a variety of both. And I think if you look at on average, there's typically a 15 to 25% prepayment rate in the bank loan space, regardless of the environment. And reasons are, the companies want to pay it off. Companies want to go to the bond market. There's merger and acquisition activity. Whatever the case may be, there is a natural prepayment rate every year. Well, with no reinvestment period, you're immediately paying down debt. You're not doing what we do in the reinvestment style where there's interest for a while. This just pays down debt immediately. So what happens is in a static CLO, you get to this magic 60-65% of the AAA being paid off in that 1 to 2 years. And it makes sense, again, the owner of the equity tranche, the greater than 50% owner or owners, call the deal. It makes sense at that point to do it. What is the benefit of a static CLO? Well, first and foremost, you can see the portfolio. It doesn't change. It's very easy for an investor to analyze and get comfortable with. 2, it's short duration. In any market environment, short duration is obviously going to be something that's highly sought after. And in the instance of CLO static debt, it's floating rate, and it's 1 to 2 years in length, and it pays a very nice relative value compared to other areas of similarly rated credit. So you have 1, an easier time to analyze. 2, you've got floating rate, short duration debt that offers significant yield. It's an attractive opportunity for debt investors. For equity investors, we believe it's also an attractive opportunity, and certainly have a long track record now illustrating that. But the point is, your biggest benefit to the static CLO is the debt cost. So instead of this cost being LIBOR 160, this cost is more like LIBOR plus 110 to LIBOR plus 115. That's a big benefit to the equity holder. And the reason why this cost is so much lower is people are only lending money, the debt holders are only lending money for a short period of time, say 1 to 2 years. So they don't require as much compensation as if you're lending money for 6 to 9 years, right? So it's a shorter duration opportunity for the debt holder, which then leads to more profit for the equity holder because your loans are still yielding revenue on average, or what's called the weighted average spread of LIBOR plus 325. So ultimate profit is very, very strong. It's also a very stable source of profit that has a really, I think, narrow range of outcomes, which we'd be happy to discuss with any interested investor. Thank you.